portion of this lesson here is about liquidity. And we're using liquidity to kind of determine what kind of instruments we trade. So liquidity refers to the amount of contracts that are traded, or the amount of buying and sell orders that are traded for that particular instrument. If an instrument has a high amount of liquidity and a high amount of contracts that are traded for that particular instrument, that generally means it has high liquidity, but it also has implications for the price action. What that generally means is that the price action will be tighter, and that stops at particular levels will not go as far deep. So they're much more likely to hold the line in the sand with a greater deal of precision. If an instrument does not have tremendous amounts of liquidity, then that means it's going to have much more wild swings in it. The intraday moves will be much more violent. Stops are going to be several layers deep because there won't be enough orders, aka liquidity, at a particular level to stop that move. So it's going to have to take a lot more orders through a lot more layers. So usually stops are several layers deep. So maybe the resistance is, say, 1383. Well, it might take, $3-5 in gold of particular stop levels to really take that out. Now, you're going to see when a level is really tight, you'll know, hey, it's been hit pretty precisely. Other than that, if that instrument generally has lower liquidity than usual, then you're going to see much larger wicks, much larger false breaks, much larger breaches, and that means you have to understand that when you place your stops, they can't be as tight and precise. Some examples of instruments so that you understand this, because maybe you're a more precise trader. Maybe you want something that moves a little slower. Maybe you like having much more precise stops and you don't like to see too many false breaks or not huge ones. Great. Well, then you want to find instruments that will meet that style. Maybe you like a lot more volatility and movement. Maybe you don't mind things swinging wildly and having wider stops. You're okay with a little breathing room in terms of the stops. If that's you, that's fine. The key is to find out what types of price action instruments you like to trade, and then trade those as much as possible. If you like both, great. Have a nice mix of the two. Examples of instruments that have lower liquidity. Gold, silver, oil are instruments that have lower levels of liquidity. That's why they're much more volatile. That's why the stops and false breaks tend to be much larger. That's why stops need to be several layers deeper, have much more space to them. So you have to factor this in. Plus, they can also have huge moves, particularly gold and oil on an intraday basis. Example, and you'll see that. You see a lot of wicks with a lot of false breaks, just a lot more volatility on a daily basis. You'll see that. Another example, as I said before, is oil. Oil has tremendous price swings because, believe it or not, it's actually not something with huge amounts of liquidity. It has some, but not tremendous amounts. If you look at the order book on the futures, you're going to see that the order books are not even close to what they are in certain other instruments. So stops need to be much wider. You need to have much more breathing room with them. And you have to understand that those things are going to need much more space to work with. And the volatility, it'll move a lot more on an intraday basis. Examples of instruments with high liquidity. A good example is the S&P. S&P tends to have very small ranges on a day, sometimes 10 points, 15, very rarely beyond 20 points, usually very precise stops, not a lot of false breaks. You're not seeing as many wicks on this here that are, piercing out into prior territory. So there's a lot greater or higher degrees of liquidity in the S&P. In terms of currencies that would translate over to that, euro dollar. The most liquid instrument in the world obviously has a tremendous amount of liquidity. So therefore, that's part of the reason why euro dollar has smaller ranges. So you're not going to need as wide a stops on a euro dollar as you would, say, a pound yen. Less liquidity, therefore much wider stops and much greater levels of volatility. Another example of an instrument that has a tremendous amount of liquidity is the Euro stocks. That's kind of like their Dow. So tremendous amount of liquidity, much smaller ranges. You can't expect huge moves in this. I mean, yeah, there was a big one today in this candle, but other than that, there wasn't much follow through in that. Talking 20 points for like 8 hours of movement. Oftentimes, to have a good day trading Euro stocks could be to get 10, 15 points. The S&P, if you can get 5, 6, 8, 10 points on it, that's generally a good day. But on gold, $5, $6, $8 would be nothing. 10, 20, 30, now that's a good day. So as a whole. if it's moving normal levels or normal in its normal way. So understand how liquidity plays into price action and how that affects it. How that's going to affect your stops, what you should be expecting in terms of targets, what should you be expecting in terms of movements.